What is up, everybody? Welcome back to Bitcoin and Markets. My name is Ansel Lindner, and today is FedWatch Day. I did FedWatch as a podcast for Bitcoin Magazine a couple years back, or starting a couple years back and stopping about 6 months ago. But we're going to revive the brand here for today because we're going to be going through the FOMC's monetary policy release that they just dropped, and also Powell's press conference, give you guys a live reaction. My coverage of this stuff is pretty unique because I have a different insight on things. I catch things live as they're saying it. And so if you want to hear what the headlines are going to be today before like this evening or tomorrow about how Powell messed up in the press conference, I will probably touch on all of that here. But okay, let's go right into the FOMC. This one right here. And so yeah, this let me back up one page and show you guys where you guys can all find this. I just searched for FOMC calendar and it brings it up here. Of course, FOMC stands for the Federal Open Market Committee. It's made up of course, the chairman and a bunch of Federal Reserve governors and presidents of the Federal Reserve Bank. So there's 12 Federal Reserve banks. Now, all of these members are not voting at any one time. I think the governors always vote, and of course, the chairman always votes, but the presidents of the individual banks, they rotate voting. And so sometimes you can see like a pivot towards more dovish language or more dovish policy or more hawkish language and more hawkish policy. And that can be because they do rotate 25% of the board like every year. So that is something to be cognizant of. Okay, but anyway, this is where you find it. It'll look like this. These little stars, like this star here for March, is when they release their summary of economic projections, their SEP. And so there will be another little box here in the releases. But okay, let's jump into this press release and see what's boilerplate and what's not. I did skim this, so let's get into it. Well, first off, before I do that, I didn't even say if they raised or lowered or stayed the same. They maintained the policy rate, 5.25 to 5.5% for their Fed funds, and they didn't do anything with QT. So QT is going to continue as normal, letting those assets roll off their balance sheet. Okay, so recent indicators suggest that economic activity has been expanding at a solid pace. This is completely different than last meeting. Last meeting, their first sentence had the word slowdown in it. And I made a point right away last time reacting to that. So this is obviously completely different. When normies read this, or I guess macro normies, when they read this, they will say, oh my gosh, solid economic activity. So they're not going to be cutting. Oh my gosh, sell, right? Because they think that Fed lowering is stimulative and Fed not lowering is hawkish, and it puts a drag on the economy, when that's not the case. Okay, the Fed follows what is going on in the market. Job gains have moderated since early last year, but remain strong. And let me just make sure I'm not muted anywhere because I'm getting a sinking feeling here. Okay, I think I'm good. The committee seeks to achieve, oh wait, where was I? Job gains have moderated since last year, but remain strong. Yeah, depends on how you measure that. There's different measures of employment, and the payrolls is more strong than households. So payrolls counts employees, and or I guess it counts jobs, and the household survey counts employees. So if someone has two jobs, it's going to make the payrolls look better, but the household will still look just like one employed person. Okay, and the unemployment rate has remained low. Inflation has eased over the past year, but remains elevated. Depends on what you're looking at. Even if you go out to a 6-month annualized, we're under 2%. I don't know what the 9-month annualized is, but it's probably close to 2%. It's only that if you had to go way back to January of last year, February of last year, to start seeing some higher, go back into that high inflation regime. Inflation was transitory. The Fed had nothing to do with it. I actually had a tweet yesterday where I showed like the curve of inflation, and I said, okay, point to where the Fed started raising rates, point to where they went to 75 basis points, point to where they paused, and you can't do it because it just looks like a smooth, bell curve, because it was transitory the whole time. They didn't do anything. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. The committee judges that the risks to achieving its employment and inflation goals are moving into better balance. And what they mean here is, so they have a dual mandate, maximum employment and stable prices. So that's their employment and inflation goals. That's their mandate. And during high inflation, the stable prices part of the mandate takes precedence, or at least that's what they did this time. It took precedence, and they were willing to sacrifice employment by slowing down the economy. So it was out of balance. They were fighting inflation versus trying to keep employment, maximum employment. But now it's coming into better balance. And that makes sense because they paused for so long. I don't know how many meetings it is, like 4 meetings now. They've only raised once, maybe in the last 6 months. So it is definitely in better balance, but that's what they're talking about there. The economic outlook is uncertain. Okay, this might get some eyebrows raised because right here they said expanding at a solid pace, and they say economic outlook is uncertain. The committee remains highly attentive to inflation risks. In support of its goals, the committee decided to maintain the target rate for the Fed funds at 5.25% to 5.5%. In considering any adjustments to the target range of the Fed funds rate, the committee will carefully assess incoming data, the evolving outlook, and balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. Okay, that's an interesting sentence. So right there, they're saying, we're not convinced yet, but they're going to cut. They're probably going to cut at the next meeting, because I did read another tweet that said, hey, the Fed is going to cut because of economic conditions, not because they've reached their target. And that is exactly the case. And that's what I have been saying the whole time. They are going to cut when they're forced to cut, not when they reach their target. So it doesn't really matter if they think that they have confidence in moving sustainably toward 2%, because that's not really going to be what makes them cut or makes them change. It's going to be economic conditions. All right. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities as described in its previous announcement plan. So no change to the QT plans. The committee is strongly committed to returning inflation to 2% objective, of course. All right, that's it for that language. Let's go over and see if he is up on the stage yet, and he is. So I am going to rewind this a little bit if my computer can catch up. Let's see. Here we go. All right, let's go a little forward here. Where is he? Where are you, Jay Powell?
To promote maximum employment.
Okay.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made good progress toward our dual mandate objectives. Inflation has eased from its highs without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. I want to assure the American people that we are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Over the past 2 years, we have significantly tightened the stance of monetary policy. Our strong actions have moved our policy rate well into restrictive territory.
Okay, just to talk a little bit about that. So they've been talking a lot about cumulative, and let me see if they actually mention that word here. They did not even mention cumulative in their press conference or in their FOMC statement. So that's very rare because they've been talking about that for a long time. And he just said, hey, we've moved a lot in the last 2 years. You know, he's talking about a cumulative narrative of what they have done. And then he said, now we've landed in quite restrictive territory. I think he might have said very restrictive territory. And that means that the Fed funds is above inflation. So if inflation is at 5% and Fed funds is at 5%, you know, that's not restrictive. But if inflation is down at 3% or 2% even, and Fed funds is at 5%, that's increasingly restrictive. And that was the big talk last meeting, was if inflation continues to fall and real yields continue to rise, so they keep their rate at 5% and inflation actually drops to 0, then the effective strength of their policy goes up, right? So they would have to lower their rate to keep it at the same restrictive amount, the same real amount. So that's probably what he's going to touch on in multiple questions here. When is the proper time to cut and all that stuff? But he's building this narrative of cumulative nature, even though they're not using that word anymore. This cumulative narrative of what they have done for policy, where they're at right now in relation to this whole narrative that they're building, and what you should think about it, what the market should think about it. Remember, this is their monetary policy. The Fed funds rate does nothing. It really does very, very little, if anything. What does matter is if what people think about the strength of the economy. That's their belief, at least, that if they can create a situation where you think there's economic growth and inflation is under control, then you will go back to spending. You'll go back to borrowing. You'll go back to expanding your business and doing more economic activity. But if you think that there's hard times ahead, what are you going to do? You're going to plow into safe havens. You're going to not hire the next worker. You're going to, a malaise will set into the economy because you just don't feel like the economy is doing well. You don't think the economy is doing well. That's how the Fed thinks. Okay. That's not necessarily correct, but that's how they think.
We've been seeing the effects on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued.
I'm going to stop sharing for a second because I just want to make sure I'm not muted because I got a sinking feeling. Okay, everything's good. Let's go back to sharing. And hit it again.
The risks to achieving our employment and inflation goals are moving into better balance.
There's that balance talk, like I said, between maximum employment and stable prices, better balance.
I have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.3%. For 2023 as a whole, GDP expanded at 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 165,000 jobs per month, a pace that is well below that seen a year ago, but still strong. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up on balance over the past year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.6% over the 12 months ending in December. Excluding the volatile food and energy categories, core PCE prices rose 2.9%. The lower inflation readings over the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee
Okay, he just said that with no actual, I mean, they do have academic, I guess, evidence behind that, but no real world evidence that higher Fed funds puts downward pressure on economic activity. That's just not the case.
Decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves...
Oh, there we go. That was pretty big, that we're at the peak. I mean, he's just straight up admitting this now. Obviously, we knew this by the dot plots, but that is a significant admission by J-Pow here that they are done hiking. But he had a caveat, and I'm going to rewind here just a second. I don't know how far back to go, like maybe here.
At its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We will continue to make our decisions meeting by meeting. We remain committed to bringing inflation back down to our 2% goal.
Okay, I'm going to try to translate Fed speak here. That's the most important part that he just went through the last couple minutes. So we're going to rewind and listen to that again, and I'm going to stop it more throughout.
By our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely.
I mean, you know what struck me just right there is these guys are supposed to be like super quantitative, super data driven. They do lots of studies. I mean, all the Federal Reserve banks do whole suites of economic analysis. But the sum total of 6 weeks of all of this data is to do nothing. Literally do nothing. It's not to raise rates by 5 basis points. I mean, at least China, sometimes you see them, they raise or lower their reserve requirements by 3 basis points or something like that. Like it's very quantitative and exact. I'm not saying they're better, but at least they appear to be more data driven, where the Fed, after all of this time, all this evolving economic data over the last 6 weeks, even you could take it out to their last rate hike. Maybe that was back in September. I can't remember now. Is just to do nothing, literally. It's to do 0 changes. Not 1 basis point, not 2, not 5, not 20. Either direction, not to change their QT by a little bit. Instead, I don't know what they target now, like maybe 80 billion or something a month. That they don't reduce their amount of QT by a little bit or increase the amount of QT by a little bit. They do literally nothing. So that's just, the Fed is just waiting and seeing, and they're going to follow where the economy leads. And we're going to look at some live charts here afterwards. But that just struck me like, literally do nothing after all of this data, being data driven, watching how things develop, watching for progress, looking at the balance of their mandate, and they literally do nothing. It's just crazy.
At its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. Okay, so he's admitting that, like I said before, which is pretty big for the Fed. And a lot of people are like, why they don't. A lot of people don't understand, why would the Fed have to lower rates? I mean, these are people that think the Fed is all powerful, right? Why would the Fed have to lower rates if the economy is actually looking okay? Like that first sentence in their statement that said, I'll just read it right here. Recent indicators suggest that economic activity has been expanding at a solid pace. He mentioned GDP there. Fourth quarter GDP came in at 3.3% annualized. 2023 GDP for the whole year was 3.1%. That's a solid growth number, really. If we could have 3% every year, that would be okay. So if the economy is doing that well, why would they need to lower rates? That's what most people struggle with. And it's for the reason that I explained earlier, is
that the policy tightness isn't necessarily the level of the Fed funds rate. At least this is their line of thinking. I'm interpreting that. So their line of thinking is that the policy tightness is not the height of the federal funds rate. It is real rates. And that is the rate above CPI or above PCE, whichever inflation measure they're using. And if inflation, quote unquote inflation, is coming down, then their policy rate is getting tighter. See? So to maintain the same amount of policy tightness, they have to lower rates. I'm not saying that's right. That's just what he's trying to say.
But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result.
One thing I was thinking about when he took his breath there and smacked his lips or whatever is that, can you imagine what Lagarde is like watching this? Christine Lagarde from the ECB. They want Powell to cut rates so badly. It doesn't really matter, but they think it does. They think that the Fed is keeping rates high, and so they can't cut rates. The euro will lose value against the dollar. Their economy will become less. Their economy is becoming less competitive at these rates. And so they want Powell to lower rates so that they can start lowering rates. I don't know. I just thought about that.
Result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment.
Okay, I know I'm going back and forth, but let's just go back a couple seconds here and see what he said there.
At the same time, reducing policy restraint too late or too our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late.
I mean, has there ever been, this is a question for viewers out there, has there ever been a period where the Fed cut too early? People might point to the late 70s, but it's very, very rare, okay, if there is such a thing. I mean, before the 70s, they really didn't even target Fed funds. You know, Volcker came in, and Volcker was the one that created the mythology around the Fed funds target rate. And it used to be a singular rate, like 5.25. Then in the Great Financial Crisis, I believe it was, Bernanke expanded it to a range, 5.25 to 5.5% that we have today. But before Volcker, they didn't really even target the Fed funds rate. That was not entirely an invention of Volcker, but he pretty much made it the central piece of their monetary policy. Prior to that, the Fed was targeting like M3. They were targeting the money supply to manage inflation. So really, I don't think there's been a period where they have ever been, you know, they cut rates and then boom, inflation picked back up again. At least not in the modern era of central banking.
Late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal.
Okay, so they're saying, okay, if we do too much, if we cut too much, then inflation will pick back up. If we don't cut enough, then we're going to crash the economy. All right, so he's trying to walk this fine line, or he's painting it as a fine line. All right, just think they're walking this fine line, and what's the answer? No change. Not 5 basis points, not 2 basis points, not a little bit less QT, a little bit more QT. There's no fine balancing, but they make you want to believe, or they want you to believe there is a fine balance, but there's no fine balancing. It's crazy.
Funds rate. The committee will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We will continue to make our decisions meeting by meeting. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored.
Okay, he's pretty much done. I just want to say that, the economy right now, like if we look forward, we are going into a recession. We're definitely in a pre-recession period because everything is lining up to be a pre-recession sort of data points that we're getting, and or at least sliding into recession. But it's going to take a lot longer than most people think. I just started seeing some stuff. We're going to listen to the comments here as well, or the questions, but I wanted to jump over to this one. This was a tweet this morning from Kobesi, the Kobesi letter. And yeah, the New York Community Bank, NYCB, the bank that acquired the collapsed Signature Bank last March, if you remember that, this morning they fell 40% after earnings. The bank announced that they will be cutting their dividend by 70% to meet regulatory requirements. They also reported a fourth quarter loss of $260 million, while expectations were for a gain of that size. So that's a difference of $500 million. This comes just a few weeks before the, bank term loan. What is the acronym? I can't remember the acronym now, but their term loan funding program, or whatever the Fed is doing, they're winding it up here in March. Then I saw them tweet out a little bit later. They had another tweet here, and this was talking about all the U.S. regional bank stocks today. New York Community Bank that we just talked about, minus 37%. Valley National Bank, negative 6%. Harbor One, negative 4%. Home Street, Lions, Comerica, Metropolitan, Citizens, all these are down on the day. And yes, this negative 3% isn't so bad, but it might be bad for banks, these bank stocks. Maybe the variance of these bank stocks is only 1 or 2%. So a 3% move is a pretty significant daily move. But look at that. All these banks are going down. And I've been talking about having this end of Q1 sort of banking crisis as a mirror to what happened last March. And it could be shaping up to be just that. But anyway, so what I'm talking about is looking forward. We see that roadblock, but the Fed will just create some new program and keep that going. That's not going to make us slide into recession necessarily. These guys can be bailed out. So looking further down, then you start getting into end of Q3, start getting to that tight squeeze at the seasonal end of Q3. So that's kind of where you have to be looking, and I'm sure that's where Powell's looking. Well, Powell's probably looking at end of Q1, and then he's looking out into the second half of 2024. But right now, guys, we're not close to actually rolling over. And so Powell can say a lot of these things because he knows he has 4 or 5 meetings until things get crazy. Now, March meeting, he probably will cut. Let me go back to this one. So this is the Fed Rate Monitor tool from investing.com. You can just Google Fed Rate monitor tool. And let me refresh because it's probably changing quite a bit today. Okay, so as Powell has been speaking, this has switched back to 53% of no cut. And May, it went up from 96% of a cut to this is 92% of a cut. So that's moving. But this is a good chance. Right now, it's a coin flip. And as we go forward and these banks start keep having problems, then this is going to get more and more likely. And this is Powell's MO. And I've been talking about this since freaking COVID started. Since they started hiking rates. I was saying Powell's MO from 2019 is to have these early cuts. So most likely he's going to cut in March. I think it's 80% right now that he cuts in March. Okay, but let's get back to this and we'll listen to some questions. So, come on, man. All right. Who's first up? Similac? Yes. She's always, or was that the first question? Let's go back. Looking. I don't think she was the first question. Oh, maybe she was. Okay.
From the New York Times. Thanks for taking our questions. Obviously, in the statement and just in your remarks there, you note that you don't want to cut interest rates without greater confidence that inflation is coming down fully. I wonder, what do you need to see at this point to gain that confidence? And as you make those decisions, how are you weighing recent strong growth in consumer spending data against the sort of solid inflation progress you've been seeing?
Sorry, say that last part again.
How are you weighing the growth data and consumption data, which have been surprisingly strong, against inflation data?
Okay, so what are we looking for to get greater confidence? Let me say that we have confidence. We're looking for greater confidence that inflation is moving sustainably down to 2%. Implicitly, we do have confidence and has been increasing, but we want to get greater confidence. What do we want to see? We want to see more good data. It's not that we're looking for better data. We're looking at continuation of the good data that we've been seeing. And a good example is inflation.
Good data. Look at the Fed's own data. The New York Empire Fed's manufacturing survey, crashing. The Dallas Fed, PMI, crashing. All of these Fed-derived statistics are crashing. And I made a comment the other day about, if you look at the things that the administration puts out, so this is pure government stats, from CPI to PCE to unemployment and all of those other jobs reports that come out, they all are looking okay. Like he said, they're looking solid. They're showing improvement. They're doing this. But when then you look at the Fed's data that they put out by hardcore wonks that are not part of the administration, it's a semi-public private institution owned by private shareholders that we don't know who it is, but we almost certain that it's Wall Street. All right. The big Wall Street banks. So they're semi-public private, and their data is showing disastrous data from the semi-private data, but from the public data from the government, it's showing good stuff. So this is the data that he's talking about. Hey, let's not focus on the bad data. Let's focus on the good data.
So we have 6 months of good inflation data. The question really is, that 6 months of good inflation data, is it sending us a true signal that we are in fact on a path, sustainable path down to 2% inflation? That's the question. And the answer will come from some more data that's also good data. It's not that the 6 month data isn't low enough. It is. It's just a question of, can we take that with confidence that we're moving sustainably down to 2%?
That's all a mishmash stuff. Also, remember, it's not a coincidence that long-term GDP projections are 2% and long-term inflation projections are 2%, because GDP is inflation, and inflation is GDP, especially in a credit-based system. All right. So they need GDP to come down, and it's not even a surprise. What is CPI at? If you look at year over year, or you look at PCE, core PCE year over year, 2.9%. I think that's what it is. What was the 1 year over year GDP number ending in 2023? 3.1%. Very close to the actual inflation number. Because inflation is growth, and growth is inflation. So by GDP coming into hotter than expected, 3.3% in Q4, that's a piece of data that he's probably like, oh man, that's not going down towards our goal. Growth and inflation is actually increasing. But anyways, okay, let's continue.
That's really what we're thinking about. In terms of growth, we've had strong growth. I mean, if you take a step back, we've had strong growth, very strong growth last year, going right into the fourth quarter. And yet we've had a very strong labor market, and we've had inflation coming down. So I think, whereas a year ago we were thinking that we needed to see some softening in economic activity, that hasn't been the case. So I think we look at stronger growth. We don't look at it as a problem. I think at this point we want to see strong growth. We want to see a strong labor market. We're not looking for a weaker labor market. We're looking for inflation to continue to come down as it has been coming down for the last 6 months.
And I'm sorry if I could just follow up very quickly. When you say that you want to make sure that it's a true signal, is there anything that you're seeing in the data that makes you doubt that it's a true signal at this stage?
No, I think I would say it seems to be the likely case that we will achieve that confidence, but we have to achieve it, and we haven't yet. And so
it's all about the employment. It's all about employment. Employment is just too strong. If employment was ticking higher, they would be confident. So it's all about the employment number.
I mean, it's a good story. We have 6 months of good inflation, but you can, and this, you can look behind those numbers and you can see that a lot of it's been coming from goods inflation, for example, and goods inflation running significantly negative. It's a reasonable assumption that over time, goods inflation will flatten out, probably approximate zero. That would mean the services sectors would have to contribute more. So, in other words, what we care about is the aggregate number, not so much the composition, but we just need to see more. That's where we are as a committee. We need to see more evidence that sort of confirms what we think we're seeing, and that tells us that gives us confidence that we're on a path to a sustainable.
See, if he had something specific, he would just say it, right? But that's not how they work, because they're not actually working on data. They're just following the market. So it's just a word salad to say nothing.
Path down to 2% inflation.
Nick Timros of the Wall Street Journal. Chair Powell, it seems to me you raised rates rapidly over the last 2 years for two reasons. One was the risk of a wage price spiral. Two, there were risks of inflation expectations becoming unanchored. This morning's ECI report for the fourth quarter shows private sector payroll growth running at a sub 4% pace. Inflation expectations are very close to where they were before the inflation emergency of the last 3 years. And given that you appear to have substantially cut off these two tail risks, and that you've judged here today current policy as well into restrictive territory, what good reason is there to keep policy rates above 5%? Are you really going to learn more waiting 6 weeks versus 3 months from now that you have avoided those two risks?
So, as you know, almost every participant on the committee does believe that it will be appropriate to reduce rates. And partly for the reasons that you say, we feel like inflation is coming down. Growth has been strong. The labor market is strong. What we're trying to do is identify a place where we're really confident about inflation getting back down to 2%, so that we can then begin the process of dialing back the restrictive level. So overall, I think people do believe, and as you know, the median participant wrote down 3 rate cuts this year. But I think to get to that place where we feel comfortable starting the process, we need some confirmation that inflation is in fact coming down sustainably to 2%.
If I could ask differently, if you hold rates high as inflation moderates, as it has been, target rates will exceed the prescriptions of the Taylor rule or its variants. What would be the reasoning for holding rates higher than the levels recommended by those rules in the current instance?
Well, look, I think, as you know, we consult a range of Taylor rules and non-Taylor kind of rules. We consult them regularly. They're in our Teal book, and they're in all the materials that we look at. But, you know, I don't think we've ever been at a place where we were setting policy by them. And they're, depending on the rule, it will tell you different things. There are many different formulations. Another way to think about it is, implicitly, is
Sorry, guys. Hold on just a second. I have kids, and they're coming. All right, guys. Sorry about that. Real life gets in the way sometimes. So, okay, let me bring back up Powell. I don't remember where I was, but we're going to just start from right here.
in theory, of course, real rates go up if holding all else equal as inflation comes down. But that doesn't mean we can mechanically adjust policy as real rates, as inflation comes down. It doesn't mean that at all, because for one thing, we don't know. We look at more than just the Fed funds rate. We look at broadly financial conditions. But in addition, we don't know with great confidence where the neutral rate of interest is at any given time. But that also doesn't mean that we wait around for to see the economy turn down, because that will be too late. So we're really in a risk management mode of managing the risk, as I mentioned in my opening remarks, managing the risk that we move too soon and move too late. And I think to move, which is where almost everyone on the committee is in favor of moving rates down this year. But the timing of that is going to be linked to our gaining confidence that inflation is on a sustainable path down to 2%.
So once again, said absolutely nothing. And if you go back and listen to this later, that he is just constantly not, I don't know how to describe it. There's no firm footing. There's no objective numbers or data that he's saying here. He's like, we think it will be appropriate if things improve, if our confidence gets more, if this or this or this. Because they don't do anything. You know, if you want inflation to come down, shrink the money supply. But they can't do that because they don't control the money supply, first off. Second off, they can't even count the money supply because it's in the shadow banking system. It's rehypothecated. There's cash and cash equivalents. There's collateral. There's repo. So they can't control it, and they can't even count it. So they have to talk as if they're in this mishmash, this milieu of just feeling. I don't know. All right, let's continue.
Hi, thanks, Chair Powell. I'd like you to key in on the use of the word in the statement that inflation still remains elevated. You've pledged to cut rates before inflation reached 2%. So that implies that there's some sort of intermediate step here on inflation, and that a cut would be consequent with a change in the statement language that inflation remains elevated. What's the step down from there?
Yeah, I don't know that we've worked out the particular statement language and that kind of thing. I would just say, if you look at where 12-month inflation is, and it's it's still well above. Core is 2.9%, for example, 12 months, which is way down from where it was. Very, very positive development, very fast decline, and the case is likely that it will continue to come down. So that's where it is. But we're wanting to see more data.
So if I could follow up on that, the statement allows that you want greater confidence on inflation falling before you cut, but it doesn't mention the other side of the mandate, a slide in employment. Would a slide in employment also bring you to the point of cutting rates?
That's a good question.
Yes. So let me say that we're not looking for that. It's not something we're looking for. But yes, if you think about, in the base case, the economy is performing well. The labor market remains strong. If we saw an unexpected...
The economy is performing well. The labor market is strong. But the economy isn't performing well, even by the Fed's own data that they put out. The economy is a disaster right now. It just hasn't quite hit the unemployment rate. But we're starting to see a lot of layoffs. UPS... I saw a tweet the other day about all these major companies that how many people they're laying off is 10,000, 20,000. I think Amazon's laying off tens of thousands of people. UPS, they just struck that deal with their union to pay their drivers $170,000 a year, and then they cut 2,500 jobs. So there is a lot of the wave of firings that is coming right now.
Weakening in certainly in the labor market, that would certainly weigh on cutting sooner. Absolutely. And if we saw inflation being stickier or higher or those sorts of things would argue for moving later. In the base case, though, where the economy is healthy and we have ongoing growth, solid growth, we have a strong labor market, we have inflation coming down. That's what people are writing their SEP around. And in that case, what we're saying is, based on that, we think we can and should take advantage of that and be careful as we approach that question of when to begin to dial back restriction.
Can or should. It would be appropriate. Confidence. Feelings. Is it any wonder that they just follow the market and they're going to panic? I don't think they'll panic in March. But I think they will cut in March. Let me see what part of March the meeting is. Okay, it's 19th through 20th. So, yeah, if we're having a mini bank crisis right then, they'll probably cut. But they're just so wishy-washy. They're not standing on anything firm at all. The only firm targets they have is 2% inflation. That's it. Maximum employment is not a concrete number. 3.7% unemployment in the United States. Is that too low? I mean, what's a healthy unemployment rate? If your unemployment rate goes too low, that's not healthy. You have to have some wiggle room for turnover rate, for maybe switching careers. People want to switch careers, so they're going to be unemployed for a certain period of time before they go get a new career. So you have to have some ability to move around. And unemployment rate at 3.7% might be too tight. Maybe it's 5% is the right number, but that's not concrete. So there's nothing concrete to stand on except for 5%, except for 2% inflation. And where do they get that from? They get that from core PCE. Not headline PCE, not core CPI or headline CPI, not month over month, not 6-month annualized, not 2-year annual change, like a 2-year annual change in PCE. No, it is year over year core PCE, which itself has different adjustments that they can do to count it differently, different weightings, different survey methods, all that stuff. It doesn't change all the time, but it changes on a semi-regular basis. Maybe every couple of years they change things up. So like 2% is not, I mean, kind of is a concrete number, but it still isn't perfectly concrete. There's no way, there's nothing. I don't know why I'm sticking on this, but this has really struck me in this press conference is the wishy-washiness of his comments. There's nothing to stand on here. The market's going to lose confidence in him. All right. So let's continue. Play.
Claire Jones, Financial Times. Just to circle back to the greater confidence aspect of the statement, there's been a lot of unanimity in recent meetings. I'm just wondering, going forward, when it comes to all needing greater confidence, is the unanimity, or at least consensus among FOMC members, about what the threshold for that greater confidence is? And if not, could you maybe tell us a little bit about the discussion today on, what the variations between FOMC members was on what constitutes enough confidence to cut rates, and also if there was any variation on how quickly that greater confidence threshold could be reached?
Oh my gosh, that's a good question. I like this lady, Financial Times. So confidence is so subjective. Like I said, it's wishy-washy. So how do you know when you're there? And how is it going to be unanimous? Is it going to be a split vote? However many voting members there are, is it going to be split down the middle with Powell being the deciding vote or something? How Powell, how do you see this? And how do you turn a subjective thing like confidence into a unanimous vote at a certain period of time?
Thank you.
We're not really at that stage. There was no proposal to cut rates. Some people did, talk about their view of the rate path. I would point you to the SEP as good evidence of where people are, although it is one cycle later. So,
man, he's fidgeting a lot.
We're not at a place of really working out those kinds of details because we weren't actively considering moving the federal funds rate down. I will say there is a wide disparity, a healthy disparity of views, and you see that in public statements, in the minutes and the transcripts when they're released every 5 years. So we do have a healthy set of differences, and I think that's actually essential for making good policy. We're also able to reach agreement generally because we listen to each other, we compromise, and even though not everybody loves what we do, they're able to, for the most part, able to join in. To me, that's a well-functioning public institution.
Rachel.
So I thought that was a really good question about the subjective nature of the word confidence. And again, he didn't answer anything.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. So over the past few years, there have been all these real-time indicators that helped us gain a sharper understanding of where the economy was, like open table data or office attendance. You've talked about vacancies in the past. And I'm wondering at the start of this year, what might be on that dashboard for you that's giving you the clearest picture of the economy, including on rents, if you could touch on that.
Including?
Rent costs.
Yeah. Well, so we're not, it's not the pandemic, so we can actually rely on more traditional forms. People are working, they're getting wages, and the economy is largely reopened and is broadly normalizing, as you see. So I wouldn't say we're looking at that sort of more innovative data as much. You point to rents, so of course we follow the components of inflation very carefully, which would be goods inflation. I talked about that a little bit. You mentioned housing inflation, so the question is, when will these lower market rents find their way into measured rents as measured in PCE inflation? And we think that's coming. and we know it's coming. It's just a question of when and how big it'll be. So, but that's in everyone's forecast, I would say. So that will help. But at the same time, we think goods inflation will probably, it's been giving a lot of disinflation to the effort, and probably that declines over time, but it may well have some more time to run. You know, the supply chains are not perfectly back to where they were. In addition, it takes time for the healing process to get into prices. So there may be still a tailwind. We'll find out with.
Okay, his answer here is interesting because, you know, he's talking about just kind of what I would call structural, like the capital structure of an economy. So supply chains getting back to normal, like 2019. Well, what would make you believe that they should get back to normal in 2019? Of course they're not. They're being shortened. There's deglobalization going on. There's sanctions around the world. There's tariffs. There's trade wars. There's pirates in the Red Sea. So where would you get like a return to normal? Most likely, the world is going to resettle at some higher level of cost for supply chains. You're not going to be able to go to the absolute lowest bidder. You're going to have to settle for maybe the third lowest bidder that's closer to you and doesn't have to go through the Red Sea, right? Or the fifth lowest bidder that doesn't have to go through the China Sea, South China Sea. So supply chains are shrinking, and the cost structure of the new supply chains is not going to go back to 2019 normal. That was peak globalization. Now we're deglobalizing. And it's the same thing for housing. It's the same thing for food prices. It's the same thing for everything in the economy. You know, in the United States, like food prices might end up being lower when they eventually resettle, because we might not be exporting as much to China, as much pork or whatever. So some food prices might come down, but other goods prices for certain things that we can only source from China, those things will go up. And the new steady state where we come to rest for prices is going to be different. Now, one thing that people complain about the CPI is they update their statistics and they update their weights. Well, of course they do, because the entire structure of the economy shifts over time. Our buying habits shift. New types of products. There will be substitutes of one nature that won't be available anymore. Okay, so of course the CPI has to be updated every so often. It just makes perfect sense. So so he's comparing this to prices and supply chains and housing and all of these markets getting back to normal, which supposedly is like 2019 levels, but they're not going to. They're going to resettle at a different level. All right.
With that. So we look at the things that relate to our mandate very carefully, and as you would imagine.
I guess just as a quick follow-up, do you feel comfortable at this point saying the economy has reached soft landing, or is that part of looking for more confidence?
No, I wouldn't say we've achieved that, and I think we have a ways to go. Inflation is still, core inflation is still well above target on a 12-month basis. 12 months is our target. Certainly, I'm encouraged, and we're encouraged by the progress, but we're not declaring victory at all at this point. We think we have a ways to go.
Thank you, Mr. Chairman. You've said that you would know the neutral rate by its works. So I'm wondering what you could tell me. How do you...
Oh, if that doesn't talk about wishy-washy statements, we'll know the neutral rate by its works.
Believe a neutral rate is working. We're telling you right now that growth is stronger. In other words, how much is the economy really being restrained right now by the current funds rate? And how much restraint does it really need additionally if inflation is still coming down?
So I think you do see in the interest-sensitive parts of the economy, you do see, for example, housing. You see the
Okay, this is going to be not a very good. It's not a very good question, and it's going to be kind of a worthless answer. I think.
effects. You do. Your second question, though, really I think is important, and that is a lot of this has come through. A lot of the disinflationary process has come through the healing of supply chains and also of the labor market. So you've seen that, that other set of factors is really different from other cycles. And has,
Okay, that's interesting, actually. So a lot of the healing has come through supply chains and employment and things like that, not money printing, not money supply. It has come through supply chains. This was a supply chain driven price outbreak and higher prices. I don't know how to say that. This was supply chain driven. And so it was always going to be transitory. And by Powell saying this, he is admitting that he still thinks that it was always going to be transitory.
has brought that working with tighter policy, which has enabled the supply side to recover, I think is that mixture has been behind what has enabled this. So no, we really do think that we're having an effect broadly across the economy. I would point to the interest-sensitive parts of the economy as well as spending generally. But it's a joint story. It's a complicated story.
But how much restraint are you actually imparting to the economy, would you say, relative to the neutral rate?
You guys think he's going to be able to answer that? He's asking for a quantitative number. How much restraint are you actually giving right now? Is Powell going to be able to answer that?
So I think it's of course, you know that it's not something you can identify with any precision, but a standard approach would be to take the nominal rate, 5.3%, let's say, and subtract sort of a forward measure of inflation. If you do that, and there are many, many ways to calculate that neutral rate, but that's one I like to do. And you're going to get to something that is materially above mainstream estimates of neutrality, of the neutral rate. You will. But at the same time, you look at the economy and you say, this is an economy that grew 3.1% last year. And you say, what does that tell you about the neutral rate? What's happening, though, is the supply side has been recovering in the middle of this. So that won't go on forever. So a lot of the growth we're seeing it isn't just a tug of war between interest rates and demand. You're getting, more activity because of labor market healing and supply chains healing. So I think the question is, when that peters out, I think the restriction will show up probably more sharply.
So no, he couldn't. All right, well, that's it for him. I think that's going to be all the main people. Let's jump into the charts and see how the markets are thinking about Fed's Powell's statement there. And we have Bitcoin. It did break down below 43,000, but it is recovering quite quickly. If we go to the daily chart, this is looking quite nice. I'm going to bring up the EMAs, or the moving averages. These aren't exponential moving averages. These are actually the simple moving averages. But what I'm watching is that 50-day moving average. Talked about back down here, and we talked about moving up and testing this 50-day moving average. We did that. We then broke it and closed above it 1 day, 2 days, and we're on the third day right now. I think closing above it 2 days in a row, even though this was a negative candle yesterday, that's pretty bullish. Right now we have this doji, but it is above the 50-day moving average. If we go back out to, or back down to the 5-minute to look at how the market reacted, we can see at 2 o'clock right here, we had big sell-off at the drop of the statement, then pretty much recovery, retracement of that move. And then we had Powell starting to speak, actually right about here. and it has rolled over, but we'll see how that goes. I was not expecting Bitcoin to be very affected by the FOMC here. It has its own fundamentals right now that are extremely strong. There's an extremely big tug of war happening in Bitcoin. So I was not expecting that the FOMC statement would matter all that much, but what it will matter to is the stock market. So let's take a look at the S&P 500. We can see the 2 o'clock drop of the statement led to a sell-off, retracement up to actual new highs, or highs after the announcement. And then when he started speaking here around 2:30 is when it sold off again, and it looks like it's going lower. But if we go to the daily here on the S&P 500, this is a pretty big red daily candle, gap down. I mean, this does not look very bullish, but what I would say is overall, it would not be surprising if we just test this previous all-time high, and I should update this. Hold on. Previous all-time high. And test that all-time high and then go back up. So that's what I'm watching on that one. Let's take a look at the US 10-year. And I drew this on Thursday's live stream. So I live stream usually Monday, Wednesday, Friday, but it's been kind of crazy recently with the days that I've been live streaming. But so this was from Thursday's live stream. I drew this wedge saying that it would probably break down, and it has done so. It actually almost got right down to the bottom of my arrow a couple days early. But overall, this is down for the 10-year. Let's go down to the 5-minute and see what this looks like. And let's just hide this arrow. Some volatility here. Pump, sell off, pump, sell off, pump. So nothing conclusive here for these different things yet. Let's take a look at US oil. This is the 5-minute chart. Let's go to the daily. I was seeing some people talking about how it was selling off, and it is. If we bring up the moving averages for this is interesting here. So for a long time, if we go back right here on the 200-day moving average, even with all the different cuts, and I have all the cuts saved on here, but I didn't put them up right now, but there's like over 5 million barrels per day. I think almost 6 million barrels per day that OPEC is underproducing. And yet price is not really doing much here. It's going sideways for a very long time. Let's see. If we just zoom out, I mean, after the Russia thing, the Russia invasion, we're talking September of 2022, and we're still at basically the same level with being range bound here. This is not showing any sort of signs of being peak cheap oil, or that it's going up higher. It tapped the 100-day moving average, and now it's falling back down below the 200-day. We'll have to see how it handles this 50-day moving average. Look, I would be surprised by any significant move in oil. Long term, it's going lower. It still is going lower. And after this FOMC meeting, it's kind of reacting negatively. So there you have it. And last one, we'll take a look at the dollar. Dollar is going up. This is the daily chart. These are the moving averages, but let me take those off. So this looks pretty strong right here. I mean, we have some horizontal resistance right around there. So we'll see if it can break above that. But nothing unexpected, guys. None of this, if you've been listening to my content, none of this is unexpected. If we zoom out on a longer time frame, all right, and let's just go through some of this, the peak, or what am I calling it? A pre-recession trade. So that's bullish stocks, bullish bonds, bullish Bitcoin. And we can go back and take a look at the S&P 500. That's pretty bullish going into pre-recession. And whenever the recession hits, like if we zoom out and we look at this arrow, this is a little bit, I mean, kind of seems crazy right now, but this is around May when it could be turning back over, and then we slide into recession, Q3, right? That is kind of what I'm looking at for the stock market. This is normal, what we should expect in a pre-recession period. Same thing with bonds. Bonds went a little bit higher than I thought they were going to go, but they have since the topped in October, and they're moving down. And then just like we just showed here, it's breaking down out of this wedge. I even talked about this move in particular. So I don't know where we were. We were probably beginning of the year here, something like that. And I remember this specifically, that I wonder if I have arrows saved on here. Let's see. No, not that one. No. What's this? No. Okay, so I don't have any arrows saved on here, but I was talking about, hey, this is going to rally, all right? And all these people all these inflationistas that are waiting for higher rates, people to de-dollarize and go away from the dollar, they are going to see a rise here as we go up. They're going to see this, and we're going to hear calls for the end of the dollar. Everyone's dumping our treasuries, blah, blah, blah. And then it's going to roll right back over and come right back down. And all these people are going to look like idiots again. And that's kind of what's happened. That is pretty much exactly what's happened. So anyway, that's that. Maybe I had that on the 2-year. Let me go and check that. That arrow. Did I? No. I don't know what that was for. But anyways, okay, let's go back to the Bitcoin chart. And we're looking at end of Q1 having a crisis, and then halving here in April. That's TBD. Right now on the daily, not looking too bad. It's a little bit red. I think it's fallen now below the 50-day moving average. Let's bring those back up. It is now back below the 50-day moving average. That's what I'm going to be watching for the rest of the day. If it closes down here, that's not the end of the world, the end of this movement in Bitcoin. There's so much going on with the demand for the ETFs, the upcoming halving, Tether buying Bitcoin, MicroStrategy buying Bitcoin. It's just a crazy amount of demand right now. And this is going to start showing up very soon in price. I'm confident in that. But okay, last but not least, let's just go to bitcoinandmarkets.com. That's my homepage. You can go and become a free member, get all the weekly updates that I put out, like the Bitcoin Fundamentals Report and podcast episodes when they drop. But I haven't actually put a podcast episode out for a while, just these live streams. We do all sorts of stuff from Premier newsletter on here. I do blog posts. We do a price forecast competition every month. So the winner of that will be announced tomorrow morning. And then I'll put out a post for February. So if you are a paid member at the $5 level or higher, you can join the price forecast competition and get a chance to win $20 in sats over the Lightning Network if you are the closest to the price at the end of the month. You have 4 or 5 days. I haven't decided on what I'm going to settle on. But you have a few days at the beginning of the month to get that entry in, and then the closest person at the end of the month wins the $20 in sats. That's it. Thanks for hanging out, and I'll see you guys on the next one. Bye.